Okay, thanks very much for joining us today on this webinar about the UK tax reforms to non-UK DOMs. My name is Alex Coghill. I lead our international private client offering here at Larkin Gowan. And for the eagle-eyed amongst you, you will see that I'm not, unfortunately, joined by Emily Willis, our head of trust today, as she's poorly, but thankfully we've got Bridie Archetta, one of our other international private client specialists on board, who has stepped in the last minute. So thank you, Bridie. We've got an awful lot to cover today, so we're going to start by recapping the existing rules on residence and domicile before diving into the changes that are coming in from 6th of April. I would just say now at the start that if you're not a non-dom or you don't work with non-doms and you're wondering why you've been invited to this webinar, then please stick with us. There's actually quite a lot of changes that will impact UK DOMs, and some of which in a very positive way. Great, so I'll hand over in the first instance to Bridie, who's going to recap the rules on residency for us.
Good afternoon, everybody. Yes, so as Alex says, we are starting with residence because it's important to understand the differences between residence and domicile, which we will go on to explain. Residence is going to get far more important for taxes in the future. So what do we mean by residence? In the UK, residence is where you are deemed to be living for tax purposes. And that is not a simple case of where you're considered to be living, where your main or only home is, where you work, where you were born, where you're a national or citizen. It's actually considering broadly the amount of days someone spends in the UK, the reasons you're inside or outside the UK, and what your future intentions are and your past circumstances are that actually determine residence for tax purposes. We determine tax residency using RDR3, which is a statutory residence test, which is set out for you here. There are 3 automatic overseas tests, 3 automatic UK tests. If you don't fit into any of those, you use a sufficient ties test down the bottom, which are explained on that in part of the slide. Now, when we use sufficient ties, we use this matrix, which you'll see if you are an arriver or a leaver. There's a matrix of how many ties you have and how many days it allows you before you become a non-resident or UK resident for tax purposes. So RDR3, again, we look at the treatment of split year when you are considered automatically resident or non-resident for a period, but you exit or enter a country partway through the tax year. So this treatment will appear where a pattern of present changes. Splitting the year is where you identify the relevant point for entry or exit from the UK and apply non-resident treatment for one part of the year and UK resident treatment for another. Whether or not you can split a tax year is ultimately a question of facts. And there are 8 cases where an individual can be eligible for split year, and 3 of them relate to exiting the UK and 5 of them relate to entering the UK. One thing to potentially note there, though, is that the tax year can be split on a date where you not necessarily arrive in the UK or exit the UK, but it's the relevant date of entry or exit, depending on the case. So just to point that one out. So now we will look at dual residency. Perfectly possible to actually be resident in 2 countries on the same during the same period. This is because there are domestic rules for each different territories, different fiscal years. So where this situation arises, you will need to establish which country you are treaty resident in. And the treaty resident country is the one that has the main taxing rights, and the treaty non-resident country only has limited taxing rights. To decide which country you are treaty resident in, there are a series of tiebreaker questions that are outlined in the treaty between the UK and that country, and ultimately it's having where you have a permanent home, centre of vital interests, habitual abode. It's like a flow chart. So note that the new rules for residency is based on the statutory residence test. So it doesn't matter if you're a treaty non-resident in the UK. What matters is whether you are UK resident under those 7 tests that we discussed previously. So we're going to do a whistle-stop tour of domicile now, which is different to residence. So what is domicile? If residence is where you live from year to year, then we look at domicile as where is your lifelong permanent home. So where you intend to spend the rest of your days depends on a number of facts and circumstances. It is not the same as citizenship and nationality. So the different types of domicile you can have are your domicile of origin or dependency, which is usually taken from your father at birth. It follows your father until the age of 16, and women married before the 1st of January 74 follow their husband's domicile as well. Now, you can get a domicile of choice, which is if you settle permanently in a new country and sever all ties to your domicile of origin. It is extremely hard to change, though, so just bear that in mind. Or we have deemed domicile, and that is if you were born in the UK with a UK domicile of origin and UK resident for 15 out of the last 20 years. So why is domicile important? 2 reasons. One was that you could claim remittance basis and not pay UK tax on foreign income and gains as long as they were kept outside of the UK indefinitely. The other was that UK inheritance tax was only charged on UK assets and not on foreign assets, which could often include an excluded property trust for reasons that Alex is going to talk about later. I'm now going to pass over to Alex to talk about the reformed taxation on non-doms.
Great. So I am going to move on to what is changing. And the first slide here is an overview of what we've had before under the old regime and what we're going to see from 6th of April 2025. So before we had what's called the remittance basis of tax. After we're going to have something similar, but it's called the foreign income and gains regime, the FIG regime, and there are some notable differences. For employees, tax on remittance basis, we had overseas workday relief for up to 3 years. Now we're going to have this for up to 4 years. For foreign income and gain that hasn't suffered UK tax because the remittance basis was claimed in a prior year, then this income and gain would be taxed when you remitted it to the UK. This is still the case. The new regime doesn't allow you to suddenly bring all that historic money to the UK and not pay tax on it, but there is a temporary repatriation facility which allows you to pay a reduced rate of tax for 3 years. Moving on to IHT, before we had IHT on worldwide assets if you were UK domiciled, and no UK IHT on foreign assets if you were non-domiciled. Now we've got IHT on worldwide assets if you are a UK resident for 10 of the last 20 years. And then finally, we're going to see some significant changes to the way trusts are taxed, and particularly settlor-interested trusts. So let me talk about each of those in a bit more detail. Right. In the past, individuals who were non-domiciled could opt to be taxed under the arising basis or the remittance basis of tax. The arising basis meant that you pay tax on your worldwide income and gains, whereas the remittance basis meant you paid UK tax on UK income and gains as normal, but were only taxed on overseas income and gains when they were actually remitted to the UK. The new position will be that new arrivals to the UK will benefit from a 100% tax relief on foreign income and gains for the first 4 years that they are tax resident. And this applies regardless of their domicile, so it can benefit both non-doms and UK doms. Only people who had 10 consecutive years of non-residence prior to their arrival can qualify for the FIG regime. Non-residence is determined under the statutory residence test that Bridie explained, and treaty non-residence doesn't count, and split years don't count either. Split years count as a year of residence rather than a year as non-residence. But importantly, Brits and other people that would have traditionally been considered UK domiciled will now be able to use the FIG regime if they've had 10 consecutive years of non-residence before coming back to the UK. Whereas previously they wouldn't have qualified for the remittance basis at all. Claiming the FIG regime will result in the loss of the tax-free personal allowance, currently £12,570, and the tax-free capital gains tax exemption, currently £3,000 per year. You can decide whether to claim this on a year-by-year basis, so you can make a claim for some years and not others, depending on your circumstances. If you're already UK resident, as of 6th of April 2025, you may still be eligible for the FIG regime if you're still within your first 4 years of residency, but you don't sort of get a brand new 4 years. So if you've been here for 1 year already, you'll get 3 years remaining. Under the FIG regime, there is no requirement to keep the foreign income and gains outside of the UK, which is a significant simplification on the current remittance basis rules. So the FIG regime will be much easier to understand and will benefit more people. Importantly, it is a 100% tax relief, no matter how the foreign income and gain are used, whereas under the old regime, the money had to be kept outside of the UK for the rest of your life, otherwise the tax relief was simply a deferral. So someone claiming the remittance basis when they were 20 could still be liable to UK tax on that foreign income and gains if they remitted it to the UK in their 80s. And that is just a completely unwieldy record-keeping requirement. So after the 4 years are up from the 5th year of UK tax residence, individuals will pay UK tax on their worldwide income and gains, and that is a lot shorter than the 15 years that could have applied under the previous remittance rules. So there are some obvious losers to the changes in the FIG regime. Non-DOMs who could have claimed the remittance basis for more than 4 years. As I say, previously, they could claim the remittance basis for 7 years without a charge and up to 15 years in total. Now it's 4 years and then that's it. There's no extensions. If you're moving partway through the year, then it's important to note that the FIG regime applies on a tax year by tax year basis. So if you moved to the UK in April 2025, you could benefit for the whole tax year for 12 months of the FIG regime. But if you moved in March 26, you'll only benefit for 1 month. So in a really extreme scenario, you might have somebody who can only benefit for 2 full tax years and then 2 months at the start and at the end, rather than the 4 full years. And unlike the remittance basis, the FIG regime does require that you report the foreign income and gains on your tax return in order to claim the exemption. So it is going to make tax returns more complicated. However, there are some winners, and we shouldn't lose sight of the fact and take advantage of those opportunities. So notably, the winners are going to be people who are moving permanently to the UK and previously would have acquired a UK domicile of choice because they're making a permanent move, they're changing their lifelong permanent home. They will now be able to access the FIG regime. Similarly, UK domiciles of origin returning to the UK, they wouldn't have been able to, they can now benefit from the FIG regime as long as they've been absent for 10 years, and previously they wouldn't. For those staying fewer than 4 years, the rules are just much simpler to operate, and there is no requirement to keep the money offshore in carefully segregated bank accounts. So you can, it's simpler to operate, and you can use your money in the UK, which is quite helpful. For current non-DOMs who have got this pool of money offshore and they can't bring it to the UK without incurring a tax charge, then they might be able to do so under this temporary repatriation facility at a lower tax rate. And for previous remittance basis users with unrealised gains, there's some rebasing that we can take advantage of, which I'll go into in more detail in a bit. But firstly, let me just throw in a couple of slides to demonstrate how the FIG regime operates. Mr. A has foreign interest, foreign gains, and some foreign losses. If he claimed the FIG regime, then everything is exempt and he pays no tax at all. If he doesn't claim the FIG regime, then he keeps his allowances and he'll pay £300 worth of tax. Certainly, if this was a remittance basis user, we would definitely say pay £300 of tax, it is much worth it in order to have free access to your money and to not have to worry about the record keeping. But under the FIG regime, well, he might as well save the little bit that he can. However, let's compare that to Mrs. B, who's got some employment income as well as foreign income. And in her scenario, she'd actually be better off not claiming the FIG regime, because without the claim, she can use the tax-free personal allowance of £12,570 and offset that against her UK employment income. And that's a more valuable deduction to her than exempting the foreign income and gains. So you can see it's going to depend on a case-by-case basis and a year-by-year basis. So that's the FIG regime. And I'll now move on to some of the other sweeteners, if you like, that were brought in with the new rules, presumably to stop the mass exodus of non-DOMs from the UK. So, you know, there are some positives. Currently, non-DOMs who work partly in the UK and partly overseas can claim the remittance basis on the proportion of their earnings that is earned overseas. So this means that a portion of their salary is not taxed as long as it's not brought to the UK. And that relief applied for 3 years, and now it's going to be extended to 4 years to align with the FIG regime. There also will be no need for those earnings to be paid into an offshore bank account, making it significantly simpler to make the claim. However, there will be an annual financial limit, which will be £300,000 or 30% of an individual's total employment income, whichever is lower, and you will lose the £12,500 tax-free personal allowance and £3,000 CGT annual exempt amount. Again, I've said this a few times, UK domiciled individuals will now potentially be able to access this very valuable relief when they couldn't previously. I've got an example on overseas workday relief for you here. So Mr. C, he's a non-dom, moved to the UK in the 24-25 tax year. He works 40% of his time overseas and 60% of his time in the UK. So he can claim overseas workday relief on 40% of his salary. As long as Mr. C had those 10 consecutive years of non-residence prior to 24-25, then he'll qualify for the FIG regime, which means he can claim overseas workday relief in the 25-26, 26-27 tax years as expected, and in 27-28. Let's say he's got some pretty significant earnings, 1.2 million. Well, in 24-25, his overseas workday relief claim is £480,000. It's not subject to UK tax because that's 40% of his time worked overseas. However, in later years, that's going to be limited to the £300,000 per year because that's lower than 30% of his earnings. Capital gains tax rebasing. This isn't really new, as we had rebasing when the non-dom rules were changed in April 2017. It's nice that they've kept the dates, to be honest, although I guess it would have been nicer if we'd had a rebasing to April 2025. That was probably pushing our luck. So it's a pretty good perk because it wipes out all of the gain arising before 5th of April 2017. It's just not subject to UK tax. So as you might expect, there's quite a lot of conditions attached to that. I don't think we have time to go through those, and frankly, I don't want to put you all to sleep, but just be aware that there's a lot of conditions. Also, please be careful. If the asset was originally bought using funds that were not clean capital, i.e. they were bought with funds that were foreign income and gains that hadn't suffered UK tax, then when you sell an asset, you're getting that original amount back, and then you're getting the gain. It's only the gain element that can qualify for this rebasing. You've still got a pot of money that relates to the original amount that you used in the first place to buy the asset for. And if that is unremitted foreign income and gains, you bring that to the UK, then that is taxed under the old remittance rules. I appreciate that's a pretty complicated point, but it's just, be careful.
Alex, I think that sounds like a pretty good deal, to be honest with you. And rebasing has always been a really useful bit of tax planning. This is a common plan in tax consideration when someone is returning to the UK or entering the UK for the first time and has significant offshore shareholdings, investments, so forth. If you were to come to the UK and sell those shares from your first day of residence, you'd previously be taxable on the whole gain on those shares, even if the gains have accrued whilst you're abroad. So if the country you're currently resident in has capital gains tax advantages or no capital gains tax at all, the most tax beneficial option would be to sell all of your shares whilst non-resident and not subject to CGT, capital gains tax, and buy them all back on the same day. This way, you'll have had a tax-free disposal and all the shares you bring to the UK will have a new uplifted base cost from the day you repurchase them.
Yeah, and that's absolutely what we've been saying to people for years. Be aware that when you come into the UK, you're potentially liable to the historic gain that's been building up in your assets. So do something about it before you become UK residents. Now, if you qualify for the big regime, you've got a 4-year period of time when you can do something about that manual rebasing. So you will lose the tax-free personal allowance and the CGT exemption. So for some people, it may not be worth it, but it just gives us a bit more flexibility than we used to have. Okay, temporary repatriation facility. So I'll start by saying I cannot stress enough that any foreign income and gains that arose before the 5th of April 2025, which remain untaxed because the remittance basis was claimed in the year that arose, will still be taxed when it is remitted to the UK, regardless of when that occurs. So in other words, the old non-dom remittance basis rules still apply to everything that has happened before 5th of April 2025. That income gain doesn't suddenly become tax-free. Unfortunately, that means we're stuck with the horribly complicated rules around remittances and mixed funds for many, many years. There will, however, be this temporary repatriation facility where you can bring back that old historic income at a reduced flat rate of 12% if you make a designation in 25-26 or 26-27, or at 15% if you don't make the designation to 27-28. So it's very limited, 3 years only, and then any future money that you want to remit is going to be taxed at the higher rates of, or normal rates of income tax and capital gains tax, so potentially 45% and 24%. Once you have taxed the money under the temporary repatriation facility, you don't actually have to bring it to the UK, although I don't see why you wouldn't, because if you're not going to bring it to the UK, then it doesn't need to be taxed anyway. And if you're going to tax it, then but leave it offshore, you've got to keep really good records to make sure you know that money has already been taxed. You can bring it to the UK in the future. So if you're going to use the repatriation facility, just bring your money to the UK. I suggested this could be good news for mixed funds. Many non-DOMs hold accounts where you've got different types of income and different types of gain and all arising from different years, and they're all mixed together, and that's why it's called a mixed fund. And if you bring money from a mixed fund back to the UK, then there are very clear statutory rules on how you tax that money. Generally, you tax at the highest rate first because that's better for HMRC. So the temporary repatriation facility could be a good way to just clear out those mixed funds and pay the 12% or 15% tax. There are terms and conditions. The key condition, I would say, is that the remittance basis must have been claimed at some point in the past. It doesn't matter how far back in the past, it could have been decades ago, and it could have been decades ago when there wasn't a remittance basis charge, the 30, 60, even 90,000 when we had that amount. So this facility will be opened up to more people, I think. Okay, inheritance tax, the juicy bits. Almost everything I've said so far is about foreign income and foreign gains, and therefore it's about income tax and capital gains tax. But inheritance tax is completely different and has completely different rules. And whilst there is some intentional overlap in terms of concepts, it is best to close the door on the income and gain position and consider IHT on a very much stand-alone basis. The key change is that inheritance tax will now be based on tax residency rather than domicile. The term domicile will effectively be replaced with the phrase long-term resident, and a long-term resident is someone who has been UK resident under SRT, remember, for at least 10 out of the last 20 years immediately preceding the year of death. And someone who has been UK resident for 9 or fewer of the last 20 tax years is not a long-term resident, which is much more of a mouthful than the term non-dom. So forgive me if I slip back into old terminology or try and enunciate very clearly when I say non-long-term residents. Anyway, those people will only be subject to UK IHT on their UK assets. Again, we're going to see some winners and some losers with this change. The losers are going to be non-doms who've been living in the UK for between 10 and 15 years. And the reason for that is because when they got to 15 years in the UK, they were considered deemed UK domicile anyway. So now that that limit has been shifted down to 10 years. Expats are going to have a tail where they have left the UK, but they're still subject to inheritance tax on their worldwide assets. And I'll come on to how that tail works in a minute. And then trusts have seen some pretty significant changes. But there are some winners. And those winners include those moving permanently to the UK and acquiring a UK domicile from that point. Previously, they couldn't benefit because they were UK domiciled from arrival. Now they've got 10 years before they're subject to worldwide IHT. UK domiciles of origin returning to the UK. So these are people that were born in the UK with a UK domicile of origin. They left, they maybe lived, I don't know, 10, 20, 50, 60 years outside the UK, and now they've come back. Previously, they would have been subject to worldwide IHT from the second year of living in the UK, and now they've got 10 years. For those leaving the UK, if you were previously UK dom, then you remained UK dom until you could demonstrate that you had permanently settled in another country and severed all ties with the UK. This really wasn't easy to do, and we've had court case after court case over the years because it's such a subjective issue and ultimately it relies on the intention of someone who has died. So you can no longer ask their opinion. Now, it's just a straightforward 10-year test. So I would say the ultimate winners are taxpayers because there is much greater certainty than we had under the old rules. So expats leaving the UK will have a tail period. The expat tail applies to those who were previously UK domiciled and non-domiciled, although there are some transitional provisions for non-doms who have already left the UK. But for expats leaving after 5th of April 2025, then they'll have this tail during which they will remain subject to worldwide IHT based on how long they were previously UK resident. It's a sliding scale, so someone who has lived in the UK for 20 years or more will have a much longer tail than someone who has lived in the UK for just 11, 12, 13 years. If you have an absence of 10 consecutive years of non-residence, then the clock is reset. However, if those 10 years are not consecutive, just please be careful. There's a bit of a quirk in the rules there. Right, let's put that into an example. So Dr. D lived in the UK for 16 years. She became non-resident from April 2027, so she's got a 6-year tail. 16 years is a 6-year tail. She will remain subject to UK IHT on her worldwide assets until April 2033, even though she has no intention to ever return to the UK. From April 2033, she's only subject to IHT on her UK assets. However, if she returns to the UK in April 35, say, then she's immediately subject to IHT on her worldwide assets again, as she will have been UK resident for 12 of the preceding 20 years and non-resident for 8 of the preceding 20 years. She didn't have those 10 consecutive years of non-residence that are needed to restart the IHT clock. Okay. Trusts. So trusts have seen some of the most controversial changes. We're going to be focusing on settlor-interested trusts, which typically means that the person putting assets into the trust could still benefit from those assets. So they hadn't really given away those assets in the same way as someone putting assets into a UK trust normally would. Previously, when a non-dom created a settlor-interested discretionary non-UK trust, the income and gain arising in the trust would typically not be taxed on the settlor, and neither would the trust assets be subject to UK IHT. This was the case even if the non-dom stayed in the UK for more than 15 years, becoming UK deemed dom at that point. The trust income and gains were protected from UK tax and the trust assets were excluded from IHT. So you ended up maintaining the non-dom tax position on the income gains and assets, even for someone that wasn't really non-dom anymore because they lived here for quite a long time. This is what the new rules are aiming to change. So from 6th of April 2025, those trust protections are going to be removed and the IHT status is going to depend on the 10 out of 20 year rule for the settlor. But, and this is a huge but, there are going to be lots of exceptions to the rules and various transitional provisions which will affect different types of trusts in different ways. So for example, where the settlor has already died, where the trusts were set up before the autumn budget, and interest in possession trusts, they're all going to have slightly different rules. I'm going to talk about how new discretionary non-residence trusts will be taxed, but existing trusts will need specific advice. And then my last point there about trusts which hold UK assets is very important because typically UK assets tend to remain within the scope of UK tax. I say typically because as always, there are exceptions to the exception. So you'll remember I said that income and gains were often not taxed on the settlor under specific protections for foreign source income. These trust protections are going to be removed, so the settlor is more likely to be taxed on the income of gains of the trust, and that's going to align the position with trusts settled by UK domiciled individuals. The settlor may be able to use the FIG regime if they're still in their first 4 years of UK tax residence to mitigate some of the tax burden there. When a trust pays out a distribution, then there's normally a tax charge, and similarly, if the trust gives a beneficiary a benefit, such as an interest-free loan, that's very common, then the beneficiary is going to pay tax on that. That's not new, but I just thought it's worth including because it is a key tax point for trusts. The new bits, I guess, are that the beneficiary might be within the FIG regime, so that might be helpful. And the beneficiary may be able to use the temporary repatriation facility for previous trust distributions. From what I've seen of those particular rules, they're going to be very complicated indeed. The IHT status of a trust is going to change quite drastically. So rather than the IHT status being fixed at a point in time when the settlor gives assets to trust, which is what we have now under the old rules, instead, the IHT status of the trust is going to track the settlor's long-term residence status. IHT will still be tested at the usual trigger points, which are when you transfer assets to trust, every 10 years when you transfer assets out of a trust, called an exit, and on the death of the settlor. So we're still going to look at it at those particular points in time, but at those points in time, the trustees are going to have to know what the settlor's long-term residence status is, and it could change. Please remember that I'm talking about new discretionary trusts here, so the old rules will apply if the settlor died before 6th of April 2025. One change which I think is slightly unexpected is that these rules are going to apply to UK trusts too. For example, a UK trust whose settlor leaves the UK for 10 consecutive years will leave the inheritance tax net and become an excluded property trust. And that's quite an unusual concept. So a UK trust set up by somebody who is UK domiciled would normally be fully within the scope of UK inheritance tax. But now if the settlor leaves the UK and ceases to become a long-term resident, i.e. effectively ceasing to become UK domiciled, then the IHT status of that trust can change. You might well get exit charges, but then once it's an excluded property trust, it shouldn't be subject to ongoing IHT charges unless the settlor returns to the UK. The easiest way for me to explain this is via an example, so hopefully that will help. Mr. E creates a settlement with £10 million of non-UK assets in November 2024 when he is non-UK resident and non-UK domiciled. He then moves to the UK in 2027. He's got 10 years before he's a long-term resident, so IHT charges come into scope from 2037, and then he leaves the UK in 2050. Right. I'll break it down into all the different IHT charging points. So in November 2024, when the trust is created, there's no entry inheritance tax charge, because at that point, Mr. E is not UK domiciled. Old rules, November 2024. In November 2034, which is the 10-year anniversary for the trust, there is no inheritance tax charge because Mr. E is not UK resident for 10 out of 20 years. So it's new rules. On the next 10-year anniversary in November 2044, Mr. E is now a long-term resident, but he's only been a long-term resident for 7 years, 2037 to 2044. So there is an inheritance tax charge, but it's prorated. And then in November 2054, at the next 10-year anniversary, Mr. E is no longer living in the UK, but he is still a long-term resident by virtue of that expat tail. So there is still another IHT charge. Then in April 2061, Mr. E stops being a long-term resident because he's left the UK for more than 10 consecutive years. He loses the expat tail. The trust comes out of the scope of inheritance tax charges, and because it comes out of it, there is an exit charge at that point. Right. I appreciate that was a lot to take in.
That's pretty complicated, Alex.
It is very complicated. That particular example is in HMRC's guidance. It's on our website, but all I can stress is you need to take bespoke advice on this. There's going to be some significant changes.
Yeah, very much so, very much so. We have had a couple of questions come through, Alex, if I can throw them at you.
Yep.
So, how will the rule apply for those who came to the UK before the 5th of April 2025 when the rules change?
Okay, so this is going back to sort of the FIG regime, is it for somebody that has arrived, say, in 24, 25?
That's it, yeah.
And so in 24, 25, if they are non-domiciled, then they might be able to access the non-dom remittance basis for 24, 25 under the old rules. And then for 25, 26, they'll be into the new FIG regime, and they'll need to consider whether they had 10 years of consecutive non-residence before they came here. If they did, then what you've got is the first year of residence is non-dom remittance basis, and then second, third, and fourth years of UK residence are under the FIG regime. So you've got both regimes working in tandem for the same person.
Okie dokie, so cool. I have another question's just popped into the chat box. I'll do these in order. I think we have time. So the first one I had was, if a UK resident gifts overseas assets to a non-resident individual, are there any UK tax or inheritance tax implications?
So can you just read that again for me, please?
Sure. If a UK resident gifts overseas assets to a non-resident individual, so offshore assets to an offshore individual, are there any UK tax or IHT implications?
So it's going to depend on the long-term resident status of the person making the gift. If that person has been in the UK for 10 out of the last 20 years, then they are subject to IHT on their worldwide assets. And when you make a gift to an individual, typically we're talking about a pet, a potentially exempt transfer, and that pet can be subject to IHT if you were to pass away within 7 years. If you are not a long-term resident, so you've been resident for 9 or fewer of the last 20 years, when you make the gift, then you're only subject to inheritance tax on your UK assets. The gift is of an offshore asset made when you are not long-term resident, and therefore it's what we call excluded property. So it's not subject to UK IHT. And interestingly, it doesn't matter if that individual then becomes long-term resident by the time they pass away. So, gosh, let's say you know, in the 8th year of UK residence, they make a gift of offshore assets. That's excluded property. Then in year 11, they pass away. Although by the time they pass away, they are subject to worldwide IHT, you're still not bringing in the excluded property gift that was made 3 years ago because the because HMRC has given that exemption. You look back at UK gifts but not overseas gifts. Does that make sense? That's quite a complicated point there. But...
yeah, it's quite complicated. It is a complicated point, but you answered it smashingly, as as I only expected. So I've got one more question.
Yeah.
This might be a long answer, so we'll see what we can do on the webinar with the time we have. How will HMRC enforce tax reporting and collecting for those exiting who have no UK assets left to enforce again, and thus no need to apply for a UK grant of probate? I don't know how big that question is.
I guess the same question. That's nothing new, right? That's if you are under old rules, if you are a non-dom, no, sorry, if you're a UK domicile and you leave the UK and you've got no more UK assets, then it's really self-assessment to when that person dies. It's self-assessment to HMRC to say, this person was UK domiciled and subject to inheritance tax on their worldwide assets. So under the new rules, that's still not going to change. It is self-assessment. I can't tell you how HMRC are going to enforce this. I can only tell you these are the rules, and I strongly recommend that you follow them to the letter, because that's what the law says.
That is all the questions I have available.
Great. Okay, well, thank you everybody for joining us. If there is anything after this webinar that you can that you wanted to ask questions, then please feel free to contact myself or Bridie. Our details are on the internet, and otherwise we hope you've enjoyed your time and you've learned something, and we look forward to hearing maybe from a couple of you if you've got any further questions.